In this problem, we're going to take a look at several different adjusting journal entries. Now, to remind you, adjusting journal entries have two purposes. One is to record the revenue or expense in the correct period, and the second, to make sure our assets and liabilities are at the correct amounts. So, we're going to walk through these together. I already have the answers up. It makes it go a little bit faster. And so what I'm going to do is click on the information for the adjusted journal entries, and we see that prepaid insurance is our first one. That balance relates to a 2-year insurance policy. So we bought it this past June. It started in July. 6 months have gone by, and now it's December. Okay, so when we first did that journal entry back in June, we debited the prepaid insurance account and we credited cash. And nothing has changed in that account since. So 6 months have gone by out of the 24 months period. Now I'm going to click on unadjusted balances, and we'll see that prepaid insurance is at $242,400. So what we can do is divide that by 24 months, then multiply that by 6. That will be the amount of insurance that's been used up, the prepaid insurance that's been used up. And so what we want to do is get prepaid insurance down to a smaller amount that represents the 18 months that are left. Right now it's at 24 months. So prepaid insurance has got to go down. Well, what are we going to debit if we're crediting that asset, prepaid insurance? Well, what happened is we used up an asset and that becomes an expense. So what we're going to do is we're going to simply debit insurance expense for $60,600 and credit prepaid insurance, and at the same time we get the insurance expense in the correct period and we get the asset account prepaid insurance down to its correct amount. Okay, now we're going to go on to the next one. Now we're dealing with prepaid rent. Now this one was paid in January to cover the company's facilities for the current year. So let's take a look at what the balance is on the unadjusted balances. We see that prepaid rent is sitting at $468,000, and that's 12 months of prepaid rent, and 12 months have gone by. That asset no longer has probable future benefit, right? So that asset has to be reduced to 0. So we're going to credit the prepaid rent by the 468, and what happened to that prepaid rent is it got used up and became rent expense. Okay, so in that one entry, we got the expense in the right period. The asset is down to the correct period. We'll go on to the next one. Wages for the year in the amount of $235,000, they won't be paid till after the year end, and they haven't been recorded yet. So there's not been a salaries expense debit yet for those those wages. So I'm going to just simply debit wage expense for the full amount, $235,000, and I'm not paying them, so I'm going to put it on a payable, wages payable for the same amount. I've got the expense in the correct period, and now I have that liability, wages payable, at the correct amount. And on the next one, they purchased a building at the beginning of the year and they depreciate it yearly. So we're going to take a full year of depreciation, and what we're going to do is straight line, and if you remember, it's cost minus residual divided by useful life. All right, so let's take a look at the unadjusted balances, and we'll see that our buildings is at $366,000. We're simply going to take that amount and divide by 30, and that'll give us 1 year of depreciation expense. And then we're going to go ahead and debit that. It's $122,000, and we're going to credit the accumulated depreciation account for the same amount. Our next entry is over interest expense. Okay, so think about this. You've taken out some kind of a note payable in this case for $17,000. Nobody sends you a bill that says your interest expense is due. You're going to probably pay it when you pay back the note. But did you incur interest expense this year? Yes, you did. And so that expense has to be recorded in the proper period. So in order to do the interest expense, we are going to take there's a simple formula, principal times rate times interest. And let's see, did they give us, oh, they actually gave us the amount. So $17,000 is the amount, and we're just going to debit interest expense. Again, we haven't paid it yet, and we're going to credit the interest payable. And so that's just 4 examples, and I hope this has been helpful.